and welcome to Bloomberg Quint. About 60 days into the lockdown, the entire economy is facing a lot of challenges. Each individual sector is facing some iteration of those challenges. And the NBFC sector, which actually went into this crisis with an existing set of troubles, is facing a new set of problems. One peculiarity is the issue of moratorium, which the Reserve Bank of India has permitted to be given to borrowers, but NBFCs have faced some delay in getting that. But joining us to talk about the entire financial sector landscape is Rashesh Shah, Chairman of the Edelweiss Group. Mr. Shah, thanks so much for taking the time to speak to us here on Bloomberg Quint. Let me throw a big picture question to you first, and then I have some specifics that I want to ask you about as well. We had a set of challenges that the NBFC sector has been facing since the collapse of IL&FS that forced them to recalibrate their liquidity management a little bit. But now, as we go into this COVID crisis, I think that liquidity management seems to have been worsened, or that has become a little tougher. Can you tell us what the landscape has looked like over the last 60 days for your NBFC side of the business? Because I know the group has many other businesses as well.
Yeah, so I always say that the good thing about being a diversified financial services company is that you always have a few businesses that are doing well and a few are struggling. But that is also the bad side. You always have a few businesses which are facing headwinds. So we have three businesses: NBFC, our asset and wealth management business, and insurance. In fact, April has been good for asset management, wealth management, and insurance business, and I can elaborate on that. But obviously, April was a very challenging month for NBFC. And as you very correctly said, I think for last 18 months since the IL&FS crisis, NBFCs have been squeezed for liquidity and a lot of other challenges. Ironically, I think by December of 2019, when we came into Jan 2020, for the first time, I felt that now at least liquidity has got managed after scraping and somehow managing it for last 18 months. Most of the NBFCs got the liquidity to a place where if you don't really go after a lot of growth, you would be able to manage. So we did come to a slightly comfortable place only in Jan, but as happens with all this, just when you think it is safe to go back in the waters, the shark comes back again. So just when it became slightly more manageable from a liquidity point of view, we had COVID. And COVID would have been easier to manage if the moratorium for NBFCs had been both ways, that NBFCs give the moratorium to their clients, but NBFCs also get that from their bankers and others. But for various reasons, the banks and all thought it is more prudent to do it on a case-by-case basis and need-by-need basis rather than a blanket moratorium for NBFCs. And also the banks wanted the government to backstop some of the risks. So in a way, there was a little bit of who will bail the cat kind of an approach. Now that the government has come out with a scheme and has actually stepped up on that, that is good news. So we do expect that liquidity has started and will start flowing to NBFCs from banks. But what has happened last about 6-7 weeks, NBFCs have been paying their obligation as per schedule. But because the advice given is you pay your obligation as per schedule and you ask for fresh loans. So rather than ask for moratorium, you ask for fresh loans. And this is what many banks are doing with their customers, because for some reason, banks want to show that very few customers are taking moratorium. We have seen in the last month a lot of commentary by banks saying only 18% of customers have availed of moratorium, only 20% of customers have availed of moratorium. So most banks, not just for NBFCs, but for everybody, would prefer that you pay as per schedule and you ask for a new or a fresh loan, which gives the bank a chance to do a fresh underwriting as well as do it on a case-by-case basis. So that is where NBFCs got squeezed on that. But unlike a normal company, NBFCs also are supposed to get payments from their customers, which have not been coming. I think about 40-45% of customers have availed of the moratorium, and it is required because they don't have cash flows, and it is good for them to take that rather than try to deteriorate their credit history. So it is, I think we should stop the clocks for everybody. So if you are stopping the clock, if you can stop it across the board, it's all right. But banks have been very engaged. They've been very proactive also. I must admit that. In fact, PSU banks have been highly supportive,
Right.
and I must compliment them that PSU banks have said, okay, show us your cash flow, show us your needs, and we will ensure that what you pay in some form or the other you can get back. So I think that has started, and with the government schemes announced, I think it will get done by June.
Okay. Mr. Shah, let me ask you a few specifics. So what percentage of your book is under moratorium? And can you tell us whether you have a moratorium in place for your from your bank's end?
No, so that is what I was saying. We like most NBFCs have decided not to ask for a moratorium from banks, but to ask for fresh funding, because the fresh funding can come on new terms, can come on with a lot of specificity as per what you need and what the banks are comfortable with and all that. So all banks are saying, pay your old dues the way they are. Don't ask for the moratorium, but ask for a fresh loan. So we have, I think between March to December, we are expecting to pay about 4,000 crores to banks as part of normal repayment schedule that we have. And our ask is that can we get this back in form of either LTRO bonds or as a loan or in some other form, so that our liquidity is also maintained, because we have also given equivalent 4,000 crores of moratorium to our customers. So whatever is a shortfall of 4,000 crores from our customers, ideally, if we had got the bank moratorium, the 4,000 and 4,000 would have got offset with each other. But because we are paying the banks 4,000 crore, we are hoping that as fresh funding, we will get that. And that is the current preferred route of most of the banks.
Okay, sorry, just one follow-up before I go to Menka. You didn't answer my question on what percentage of your loans is under moratorium. For private banks, the range has been about 30%. For NBFCs, it has varied depending on where your dominant credit exposure is. So can you tell me what that number is, wholesale and retail? Also, how does this make sense that banks give you fresh funding and you use that to repay them? Logically, it sort of doesn't really make sense to me, does it?
The other way. You first repay them, then they give you fresh funding. So because all of us have liquidity reserves, we have liquidity cushion, like Edelweiss has always maintained between 5 to 6,000 crores of liquidity cushion in our NBFC. We have that cushion which we are using to pay. But the thing about reserve is you don't want the reserve to get over. Like in your car, you have the gas, you have the petrol in reserve. It's only for emergency, you don't want to get over. And if it is getting over, it has to be replenished. So the way it is working is currently you are repaying first from your reserves, and then with the fresh funding is replenishing that reserve so that you get back to normalcy as fast as possible. To answer your earlier question in terms of the moratorium on retail, it's actually very product by product. So on things like SME loans and all, we are seeing about 40% of the clients are under moratorium. In home loans and all, it's much lower. It's about 22%, because most of the home loan borrowers are also salaried individuals who are able to pay because their salaries are still coming. So it varies from product to product. But if you look at the quantum, the number of customers, I would also say that for us and for most NBFCs, about 35 to 38% of the customers have availed of this.
Of loan AUM?
Of the total outstanding that is there, or I would say of the total that was due for the month, about 35 to 38% is under moratorium or have availed of the moratorium.
Menka, over to you.
Ira, I'll just follow up on, I think, the question that you were pressing on. Hi, Mr. Shah, and good to have you. I think you mentioned that you offered a moratorium of up to 4,000 crore rupees to your customers, and you would have wished that the banks had done the same for you. Instead, you had to pay 4,000 crores as outstandings to the banks. Are they now lending you fresh money? Is there a time gap between you being able to repay them and getting fresh money? And how long will your reserves last then?
So ideally, all banks want to take about 4 to 8 weeks between when you pay them and they do a fresh underwriting and fresh. As I said, they want to do it on a case-by-case basis or need-by-need basis. But as I said, the banks have been very engaged. A lot of proposals are being processed. A few approvals have also started coming in. And I think a lot of the banks were also waiting for the government guidelines that came out last week on the 30,000 crore and the 45,000 crores and all. So now that the government guidelines, and today we saw that the cabinet has also approved the special liquidity purpose vehicle for NBFCs and all, a lot of this will get operationalized much faster. But banks have been engaged and approvals have been coming, but a lot of after approvals you still have documentation and other things to go through. And what banks, as you said, reserves don't last forever, they get over.
Right.
But what most banks are seeing is most NBFCs have enough reserves till end of June or end of July. So they are saying pay first and then take fresh after that. And that also imposes some sort of discipline on the industry and all. So as long as banks are engaged and proactive and all, and I must say they have been, I think this will work out in that way.
Mr. Shah, can I ask you candidly, not just for your company, but I think for across the industry, I assume the experience you're having is the experience that many others in the industry are having. Does this very sort of narrow time gap, between, or rather just the time gap between you having to pay the banks loaning you fresh funds, and this complex setup, and you potentially, or people in the industry potentially running out of reserves by June, does this make you uncomfortable? Do you believe that this could have been better managed, that the liquidity situation for NBFCs could have been better planned at the time when the moratorium was extended to all borrowers?
So as I said, I think ideally when you stop the clock, you should stop the clock across the board so that it becomes easier. But it's not that easy. It's more complex because we have seen people having to pay lease rentals and all. Did you stop the clock on lease rentals or not? You were told not to stop the clock on paying employee salaries. So somewhere clocks were stopped, somewhere they were not stopped. And a lot of this was not a P&L issue, it is a cash flow issue. So ideally that would have been a lot easier, but it would also have been automatic. I think while this particular approach, which is you pay first and then get fresh funding, allows the banks to take a fresh look at your books, at your borrowability and a lot of other things, and the fresh condition, the interest rates could be different, the structuring of the loan can be different, all of that. So I think it does give, it does take the automaticness out of it. It does bring a lot of specificity to that, and it's also work. But as I said, it also imposes a lot of discipline on all of us, and it's actually one more stress test on the liquidity reserves of NBFC. The fact is, between March to now, all NBFCs have been able to pay their dues as per schedule. Itself speaks volumes of the fact that over the last 18 months, NBFCs have managed their liquidity and all, because as you know, commercial paper market has gone away. Even the mutual fund bond market has got very dislocated. Recently, the events that have happened in the mutual fund credit funds and all have also propagated that. So I think banks are the ones who are now having all the liquidity. And as I said, especially PSU banks, I must give them full dues. They have been very, very responsive and responsible.
On a scale of on a scale of 1 to 100, what percentage? Sorry, let me rephrase that. What percentage chance do you give to the fact by June end, all these financing arrangements will not necessarily come into place for the industry, or that potentially that banks might choose to put money in the hands of some of the stronger NBFCs, but not necessarily the mid-sized or some of the slightly more stressed, NBFCs. Do you expect that June end we might see some volatility in the space from a business point of view?
No, I think I would not be an alarmist on this, and I'll tell you why. Because I think what government has come out with, maybe what you are saying is a risk of a lot of smaller NBFCs which have maybe smaller books. But the 30,000 crore facility that government has come out with, for which is special purpose vehicle for NBFCs, bonds and others, is a good initiative. The 45,000 crores of the partial credit guarantee scheme is also a good initiative. All this plus the banks and NHB and NABARD and also got a lot of funding from RBI, which is also all getting processed, and banks have a lot of cash. So banks also understand, and banks have handled this a lot more. See, as compared to the mutual fund industry, the banking industry is a lot evolved in dealing with clients and all that. I think the mutual fund and the bond market is a lot more immature and is a lot more unevolved because they have not seen credit cycles across. But banks have seen that. Banks have been funding NBFCs for the last here. They have a lot of understanding of that. They have the understanding of the underlying portfolio. So a bank can come and look at your portfolio and see what is there, while a mutual fund cannot do that. So I
But
think
Mr. Shah,
this.
sorry, I'm so sorry to briefly interrupt you. You've been saying that banks will look at the underlying portfolio. They will use this as an opportunity to renegotiate terms of the loan. They want to make sure that this is some sort of stress test on the reserves of the NBFCs. All of that seems to sound to me, and maybe I'm wrong, but it sounds to me that banks want to be doubly careful of who they're giving their money to, which is not very fair from the bank point of view. But from the NBFC industry point of view, I'm just wondering if that will mean that while the strong end of the industry and maybe the top 2, 3, 4 players will be all right June end, the middle and the lower end of the industry will be in for a crisis of sorts, because we only have about now 30, 40 days for all these government measures also to be activated and implemented.
Yeah, so I think 30-40 days is a long time. The 30,000 crore of special purpose window from the government is a fairly good amount if you look at the data and all. So again, as I said, I am not an alarmist. I do think I agree with you 100%, Menka. There is a lot of risk aversion in the system, and as I always said that we have to create an environment where the risk to the banks and the risk to the banker himself also comes down. So I think because in the past when bankers had bad loans and all, I think even individuals have been hauled up and all. We need to get that fear culture out of the way. But as long as we can do that, I think the banks have been risk covers, not just with NBFCs, they have been risk covers with everybody. Everybody is risk covers. Mutual funds are risk covers, banks are risk covers, NBFCs are risk covers. So I wouldn't say risk aversion is a problem. I think how to overcome that is the main issue. And the government measures. See, ultimately it became almost like who is the risk taker of the last resort? Should it be banks or should it be government? Now, all over the world, we are seeing that government has stepped up and said, I'm the risk taker of the last resort, because you should remember that government is also a partner in the profits of the industry. When you pay 30% tax, government is a 30% partner in that. So if the government does not backstop risk and the banks are not willing to take risk, anyway activity will come down, tax revenues will come down. So either there is a visible cost or an invisible cost for the government, and that's happening all over the world. So I think in India also government has stepped up, and government has also indicated they are willing to do more also as required. They've been very engaged, and I think this was the main issue: who takes risk. And you are absolutely right, banks have been risk covers. But with what government has been doing and the banks, the way they've been stepping up and they've been understanding the needs and all that, I do think there won't be a crisis. But as I said, I'm not an alarmist, and it's uncomfortable. That goes without saying. But it's not an alarming situation that I think what has happened in the last 18 months. I think this gloom doom around NBFCs has become a favorite for a lot of people. People want to say that NBFCs, because last 18 months also, and in 18 months also, we have seen a huge amount of crunch. Commercial paper market has gone away. I would say most NBFCs, except a few, most NBFCs have been able to navigate, and this is 18 months. The liquidity crisis in India in earlier environments was never more than 3 to 4 months. By March of this year, we had 18 months, starting from September 2018 till March 2020. We had 18 months of squeeze on liquidity with periodic issues and all, and most NBFCs have been able to manage. Yes, growth has gone away, earnings have been under pressure, NBFCs have shrunk their balance sheet. We have shrunk our balance sheet by 8,000 crore in the last year. It has come at a cost, but NBFCs have managed it. So I think there is also a lot of, because currently because of COVID, there is a lot of stress all around, from airline industry to hospitality to media to auto to F&B to retail. Everybody is under stress, and I somehow think that the issues of the NBFC industry, and as you correctly said, there is this two-way moratorium versus one-way moratorium has been an issue, but it's being played out a lot. And I must compliment the government. They have stepped up and they have said we will ensure that there are no accidents that happen. So I think we should keep that in mind. We should see how fast it gets operationalized. I was very happy to see the cabinet approving the special scheme today. So all this is going, I think as per the plan that the government and RBI and the banks have.
Yeah, Mr. Shah, I mean, I get your points, and I get that you're saying that, banks are being well-natured about it, but I am concerned about the timelines that you've put down and the reserves that you said that might run out by the end of June. I also think that, I wonder if the government would have done more. But I'll come to some of those questions and broader economy questions in just a bit. I'm going to throw it back to Ira because I know she has more, probing questions around the NBFC industry itself.
Mr. Shah, actually, I have two. One is if you can help us, your latest investor presentation, which was end of December, suggested that your overall liquidity is at about 22% of balance sheet, that the liquidity available is 2.8 times of the 3-month payment. Net, given what you have paid back to banks and what you may have freshly received from banks, what would those numbers look like now, sir?
We will be disclosing it in our results and all because audit and all is going on. But we have last 18 months, we have maintained anywhere between 14-15% to 18-20% of our borrowing as liquidity reserve. At any point, we have between about 6 to 8,000 crores plus liquidity reserves, and we currently also continue to have that. We always have maintained this kind of reserves. And as I said, as we have paid, we also have been getting some funding from banks, even in the normal course, and this LTRO and other funding and all. So I think we will be disclosing this, very soon. But I would say we have never gone below 10% of the balance sheet as liquidity reserve available, and we have always been between 10 to 20. Last 18 months, the average has been about 14-15% of our balance sheet has been liquidity reserve all the time. And we would continue to maintain that. As you know,
of 3-month payments, so that seems to be the easiest metric to understand for the rest of us. So if it was 2.8x 3-month payments in December, what would it roughly be now?
It would always be between 1.5 to 2.5 is what we have always been. December, we had accumulated a lot more liquidity than we required, which is a good thing. In hindsight, it was a good that we came into Jan with a lot of liquidity. So we have been aiming for 2 times. So we have always been between 1.5 to 2.5 times of that as a number. But December was slightly better than that. And we will come out with our update, very soon. We do share this with banks and the rating agencies and everybody. And currently, as I said, the reserves are getting used, but they will get replenished also. And we are doing a lot of other things also in Edelweiss. We have our advisory business because, everybody assumed that we are just an NBFC business. With NBFC, we also have a very large advisory business, which is asset management and wealth management, which makes a fair amount of profit. And as you know, last year we had raised equity in that from Cora and Sanaka. We had raised about $125 million. We are also engaged, and we have disclosed it to our investors and others, that we are engaged in raising another 15 to 20% equity in that business, which will also give us some more equity capital, because liquidity has 2 things. One is borrowing and one is equity. And given what has happened with COVID and all that, our board has decided that we should strengthen up on equity. If you see in the last 18 months, we raised about $250 million in credit from CDPQ in our credit business in May last year. And then we raised another $125 million from Cora Sanaka in the advisory business. So we already raised about $375 million into these 2 businesses. And we have announced that we will raise another $150 million in our advisory business in the near term to just strengthen the overall balance sheet of Edelweiss as we go along. So if we raise this, then both our businesses, advisory as well as credit, would be adequately capitalized. And as I said, this is equity. We still need borrowing, because in a credit business, you need both equity and borrowing. In advisory business, you need mainly equity to scale that up. But we have these 3 businesses. All of them will get fairly well capitalized at the end of this. And I must say, in April, though it was not a good month for Indian economy as a whole because of the lockdown, for advisory businesses, it was a fairly good month. And you will see the numbers of our insurance business also. We did end up growing a little bit out there also. So insurance and advisory, April was good. Credit, obviously, we all were grappling with this liquidity issue in April. We continue to grapple with that. And I think all this will also get solved very soon. And I'm optimistic. But I think the real impact of COVID on Indian economy will get unfolded over the next few months. And I would say we should not look at only NBFC, we should look at financial services as a whole, because there are many parts of financial services that are doing well. In fact, insurance industry is doing well. And as we speak to a lot of insurance companies, they will continue to do well even in this year.
Okay, so two short follow-up questions. One, your on the credit business, the bank borrowing to bond market borrowing ratio, I suspect would have changed. Correct me if I'm wrong, but I haven't seen Edelweiss go to the debt markets to raise very much money. Is that because you suspect that the credit spreads for you in the debt markets would remain elevated?
No, if you see in the last 18 months, we would have raised about 4,000 crores from the debt market also. But of course, in the debt market, the mutual funds have been seeing outflows and all. And as you see in the mutual fund, in credit funds, the AUM has come down. So yes, the mutual fund market has not been available. Commercial paper market has not been there, and commercial paper market has become so uncertain that very few people are using that, because if you have to roll over every 2 months, you can't use that money for your business, because you will just keep it in cash. So if you raise the money, you will hold it as cash, because if you're going to anyway hold cash for the next 3 months, a 2-month commercial paper doesn't add to anything. So given that, I think the mutual funds, both commercial paper market and NCD market, has come down. We have done a few retail bond issuances. We have sold bonds to HNI customers also. We have done that. We have also been borrowing from banks. We have also done bond offerings to banks also. So if you go back and see the last 18 months, we have also accessed the bond market, but the dependency on banks have increased vis-a-vis the bond market. Currently, I think our total outstanding would currently be almost half and half. If you see an investor presentation in June, you will see that about 50% of our borrowing is NCD and 50% is from banks. It changes a little bit from quarter to quarter, but that is broadly the current outstanding mix that we have.
Okay. So last question from me, which is on the evolving asset quality picture. Right now we are talking about the moratorium, which is a 3-month moratorium. I don't know if it gets extended or not, but at least those of us on the outside are sort of flying blind on what the asset quality implications of the portfolio under moratorium is going to be. One way to judge it, which Bajaj Finance recently did, was to say that X% of the portfolio under moratorium has had previous instances of stress or previous pointers which suggest some sort of stress. How will you can you tell us what you are doing within your portfolio to judge the eventual asset quality stress from the portfolio under moratorium and the benchmarks you're using?
Absolutely. I think there will be some amount of stress, and additional credit cost and all will come about for sure for everybody. I think fortunately, unfortunately, the wholesale business was under stress for the last 18 months. So a lot of the stress test on that has already happened. I would assume currently, from whatever analysis we are doing, incremental stress on that, incremental because of COVID, will not be as much, because for last 18 months, a lot of the project had got stalled, and liquidity and last mile funding and completion financing was not there for a lot of projects. So I would say for most banks and NBFCs, the wholesale book, which for the last 4-5 years for banks also, the wholesale credit book and the corporate credit book has been the pain point, have got stress tested, and I think that was the old story. I think the new story will be mainly around retail credit, and there are two parts to that. I think we have a retail book also. In that, when we look at our home loan portfolio, we feel fairly comfortable, because home loan customers, because they are long duration loans, and it is collateralized with a home and all that, should do okay from an asset quality or a credit cost point of view. I think where there are short-term uncollateralized unsecured loans, where if you don't pay for 3 months or 6 months, because the loan duration is only 8-9 months, it's very hard to catch up. While in a home loan, if it's a 5-year loan, adding 1 more year to that loan is not going to change it much. So I think long-term loans and collateralized loans, both wholesale and retail, will not see a lot of impact. Short-term loans, uncollateralized loans, will see a lot of impact. We don't have a large book on that, so we are very small on the retail side. So for us, incrementally, we don't expect, because we have been taking a lot of trouble and pain over the last few years. Yes, our credit cost will go up, but our credit cost estimates, we used to be at about 2% of our book as credit cost per year. we had already upped it to 4.5, and I think that 4.5 may go to 5 as a credit cost as a percentage of the book. So they might be increased, but the real increase from 2 to 4 happened in the last 18 months, which is a large increase.
You're comfortable with the security cover that you have, particularly on the wholesale book, sir?
Yeah, actually, if you look at the NBFC business or the credit business or the bank business as a whole, what we have seen over the last few years is credit cost can pain you, it can be trouble, it can impact your earnings, but credit cost is part of the business. It's a known unknown in that sense, because you might have credit cost of 2% or 5% or 6% or 8%. It will impair your earnings, maybe it will impair your equity for a year or so, but credit cost, we have seen banks have had huge NPAs and all that. Credit cost is a problem of earnings. The problem that most NBFCs and others are now grappling with is asset liability cost, ALM cost. When suddenly the commercial paper market closed down, then the bond market closed down, then this bank entire, the moratorium issue has come about. All this creates a lot of ALM risk. And I call ALM risk as an unknown unknown, while credit cost is a known unknown. If you are in the credit business, you will have bad debts. That is part and parcel of that. You might overestimate or underestimate that. That affects your earnings. While ALM is, because even a 1 crore shortfall is a 1 crore shortfall. You can't quantify that. And I think what last 18 months have shown most NBFCs and all, and even in a way, what we saw when this, Templeton Mutual Fund episode happened, it's an ALM issue, because you have a bond fund which is overnight a redemption, open-ended mutual fund on one side, and you're holding 3-year, 5-year bonds on the other side. And in an illiquid market, liquidity has just gone away. So we are now in a situation in India where we are saying NBFCs cannot take ALM risk, mutual funds can't take ALM risk, then banks are the only ones who can take ALM risk, because ALM risk is inevitable. All credit happens because the savers of money want to keep money at the short end. You want to keep your money in the bank that you can withdraw anytime, while you as a borrower of home loan want a loan for 5 years or 7 years. So somebody in the system has to take that ALM risk. Banks can take it because they have RBI backstop. But in the last 18 months, we have said NBFCs should not take it. Now we are saying mutual funds also cannot take it. So who will take that? And I think over the last 18 months, NBFCs have also felt that the entire approach towards NBFC has been more step-motherly from a backstop point of view, and hence increasingly NBFCs have been curtailed in terms of what they can do and they cannot do. But one thing has become very clear after this, that NBFCs should not take any ALM risk at all.
Right, Menka, to you for the closing.
Ira, I know we're at the end of our time with Mr. Shah, so I'm going to ask one quick last question, which is just to pull out and take a look at the economy as a whole. You're speaking of bankers being risk averse, or maybe even now NBFCs being risk averse and shrinking their balance sheets. I'm going to ask you if you think the finance minister has been risk averse in the package that she's laid out over the last 5 days. And then in a sense, it's a package that is not oriented towards growth. And the fear that experts have is if we don't grow our way out of these troubles, that we might actually be in deeper trouble 1 year down the line. What do you make, Mr. Shah, of what has been put on offer by the finance minister and this government?
I think, overall the economy needs 3 things. It needed liquidity, it needed confidence, and it needs investments. Now, I think liquidity has to be the first one. So on that count, I'm happy. See, we are in a environment, the glass is always going to be half full and half empty. So there are things the finance minister could have done and should do, and there are things they've done which are also fairly good. So I think the idea is to take a balanced view. I think addressing the liquidity issue is a good start. It's not enough, but it's a good start, because first you needed to solve liquidity. Now with liquidity, you have to solve the confidence and risk aversion problem, which also part of the risk government has taken. The 3 lakh crore MSME loan where government has said we will be the backstop for risk. The 30,000 NBFC window where government has said we will be the backstop of risk. So some risk they have taken. Could they take more? I think eventually all governments around the world have had to take a lot more risk on themselves rather than pass it on to the banking system. So I think we have to start with liquidity, which is the beginning. We have to slowly move to confidence, which will drive consumption. So I do hope that there is a follow through on that, and government does cut tax rates and GST rates for getting the consumption cycle going. And then we have to get the investment cycle going, which will also mean ease of doing business and other investment related incentives for that. But it has to be three-stage. You can't start consumption if there is no liquidity. I think what happened all over the world in March and April, liquidity dried up everywhere in the world. But abroad, these central banks stepped up very quickly and infused a lot of liquidity. So when we look at global market, we see the liquidity fear had gone away. India, that is still lingering on, because no matter how much money RBI has pumped into the banks, it has not flowed through the liquidity transmission has not happened, and government had to first break that barrier, which I think is what the finance minister has tried to do. I do hope it gets broken very quickly, the liquidity barrier, and then we should follow it up with getting confidence and consumption back. For that, I think tax cuts and all will be very important part to play. And then we need investments, and for that, reforms will play a big role. Government has already hinted of getting reforms started, but I think reforms will facilitate investments. Tax cuts will facilitate consumption, and some amount of risk backstop will facilitate liquidity.
All right. I do hope it works out, as you've just pointed out, Mr. Shah. In the conversation, I didn't get a chance to point out that I know while they've offered this 30,000 crores as a special liquidity scheme, by all measure and all analysts suggest that it's such a small fraction of the total borrowings of NBFCs. But we'll leave it there. I know that there's so much more to talk about in this sector. We'll come back and revisit in a few months to see, hopefully, if things have panned out as you've hoped. Rashesh Shah, thank you so much for joining us here on Bloomberg Quint.
Thank you, Ira. Thank you, Menka.